Happy Friday morning, everybody. We are going to do a live stream here to talk about stock investing, stock trading, and the last couple of weeks, oil prices have been going up fast. You're seeing a chart for oil prices over the last year, and you can really see that, geez, over the course of a couple of weeks, we have really increased the oil price, or I should say, the world has seen oil prices really increase. And oil is a really important commodity because you jump in your car and you drive around, you're using oil, and you look at all the plastics around you. Well, that's oil. I mean, oil is in so many things. So as oil prices go up, the cost of transportation, delivering product, making product, just about everything goes up, and it's just a fact of life. So higher oil prices, in my observation, it tends to lead to bad stock markets and bad economies. It's just hard to have an economy that's booming when everybody has to pay a lot more for their energy, and specifically petro energy. So that's what's going on with the oil markets. Anything you want to add there, Daryl?
Well, you're right. I mean, crude oil is in almost everything we touch. So it definitely filters down through the economy when it goes higher and increases costs for producers and consumers as well.
And as we went into 2026, the oil prices were relatively low. Look at this chart. The oil prices really went up back in 2021, beginning of 2022. And 2022 was a tough year for stocks. Okay. It was a really tough year. And since then, we've been seeing a declining oil price. And we've seen a decline in inflation. And remember back in 2022, we had horrible inflation.
Yep.
Well, guess why? Everything's more expensive. So we're seeing this oil price really increase. And if it stayed at $87 per barrel, I don't think that's a giant problem. I think everybody could adjust. Okay, EVs are going to be a little more popular now. I imagine if oil prices and gasoline prices, diesel prices go up, EVs will come back into the picture as a pretty attractive alternative to save money. But my concern is, what if this thing keeps rising and we get up to $125 per barrel, $150 per barrel? It cripples some industries. It kind of really takes the economy and slows it down drastically, because just think about your household budget. Hey, I used to spend, I'm in California, so you'll have to take that with a grain of salt. I know when I travel to Texas, gasoline prices are like less than half what we pay out here. We pay like $5 a gallon, and last time I was in Texas, I paid like $2.25 a gallon. It's like, geez, can I bring some of this stuff back home? But here, let's say you're consuming $200 a month in gasoline, maybe $300. Well, what if overnight you're not consuming $500 of gasoline? That's a pretty good chunk out of your discretionary income, discretionary money. So now you're like, hey, I don't want to go out to eat. I don't want to go buy a new shirt, or I don't want to go on vacation. It just really changes behavior. And businesses as well. You start seeing transportation companies attach a surcharge for fuel because they can't afford not to charge. The transportation companies don't have massive margins. They have margins that they can live with. But this energy cost that they're putting diesel into their trucks, that they have to pay literally twice as much, they're going to surcharge the customer. And the customers know that that's coming. So
Yep.
now the input cost into that supply chain just went up overnight. So all these things, are not good. And we had a jobs report. The jobs report was not good. Jobs report is not helping out. We were thinking, hey, we're going to get about 59,000 jobs created. We got a negative 92. Man, was that a swing and a miss. And to me, that was like, not good. Higher oil prices. Oil prices have been increasing fast over the last 2 weeks. And now we got this report. Now, if this is a one timer, like, hey, there was maybe that weather had something to do with not a lot of people getting jobs, and that had something to, I don't know. But if we get to next month and we get to a couple months of negative, okay, that means that we're probably headed toward recession, which is bad for stocks. Your thoughts, Daryl, on the jobs report?
Yeah, the non-farm payrolls gets adjusted, so I don't get too terribly excited about one report because they do get revised over time. I think about a year out, they're still revising those numbers.
Mm,
So I don't necessarily look at just one report. Yeah, that's definitely not a good number, but we'll have to, take a look at several reports over the next 2 or 3 months and
yeah.
see what kind of trends emerge, just like you said.
Yeah, I agree with you that, I'm not taking this one as, okay, this is what's going to happen for the next, 24 months. But it's kind of like, okay, we got a bad one. Next month, if we have another bad one, and the month after that, we have another bad one. Okay. Now we're all concerned because
Right.
we're having these bad jobs reports. It's showing that the economy is, it's not good. It's not good. And you got higher energy costs. So it's a kind of a negative way to start our live stream, but it's really information that we got to take in as investors. We're going to talk about a topic that Daryl's kind of prepped on is when to sell. As we lead into that topic, let me just comment on. Okay, we have a jobs report. It came out. We have oil prices. How do I take that into my investing plan? Right. So I have a long-term mission, which is to make my portfolio go up in value. And my goal is to double every 5 years. Okay. As from year to year, quarter to quarter, I am taking in what's going on with the economy, what's going on with the market, and it does influence what I do. It's not specifically, oil prices are at $86 a barrel, so I'm going to sell 40% of my portfolio and buy, X. That's not what I do. But I do take that into account and say, how does it affect the sectors I'm in, and potentially where should I be adding capital to deal with a higher oil environment? What do I own that could help me during a recession? But I don't abandon my long-term mission. That's always the mission, is to double. I can't double my portfolio without being in technology, without being in communication services, without being in the right financial services companies, without being in the right consumer discretionary companies. Can't do it. So I don't leave those spaces, but I do take this information into account, and I have it be just one more, piece of information that I could use to outperform the market in 2026, to stay on my path of, doubling my portfolio every 5 years. We dealt with this in we're not even close to where we were in 2022, but we dealt with this in 2022, which we had multiple factors kind of converging and taking the stock market lower. So let's go into your topic. Anything else you want to share on how you use this economic data that we're getting into your process, Daryl? Would be interesting to hear.
Okay. So we look at several charts that I use, but we talked about this on Wednesday, the S&P 500. So we have this one support line right here that was established back on the or 20th, I guess, of January, where we set a low. And it has been tested one time. It was tested intraday, tested once more. We bounced off. But on this particular day, we cut through intraday down below this low. So, and you can also see that we have lower lows at the moment, not necessarily, I should say, lower highs. We don't necessarily have lower lows just yet, but we are creating a wedge, which at some point needs to be resolved either to the upside or to the downside. Given the way that the market has been moving, I'm leaning towards more of the downside. So I'm preparing for that a little bit. That doesn't mean I go out and sell everything. I'm not that kind of emotional trader, but I do take action in some places to trim my portfolio if I think they are more affected by certain inputs into the economy. So yesterday we did have above average volume, and we did close lower than we opened. Today we are down on the S&P by another 0.6%. So that's going to put us down to about 67.94. So somewhere right in here. So anyway, I do keep an eye on this stuff. I share these charts all the time. The 5-day moving average on the put call ratio is going up. The raw data is coming down day by day. The 5-day average is still moving up. What's normal is around 0.55, and we're sitting up around 0.66 right now on the 5-day moving average. We also have moved into bearish territory on the RSI, and we are bearish on the PPO. So last Friday, we were asked about, when you choose to sell, and I shared my particular process, and I'll share it again today because what actually has happened this week makes it maybe a little bit clearer. So I did have some questions throughout the week where I could tell that it wasn't exactly clear. So this is UPS. This is a really busy chart, and this is the chart that I use pretty much in my daily review of my specific holdings. I don't necessarily share charts with all these lines because it doesn't make sense to anybody else. But I use these chandelier exits. So, like I said last week, the chandelier exit takes the average true range of the stock price range. So it's a volatility, takes volatility into the input. And then I have that multiplied by a multiplier. The orange line is multiplied by 3. So it takes the average true range of all these movements, multiplies it by 3. That gives me a chandelier exit value, which is actually tracked with this orange line, which you can see in the background right here. So my orange line that I set horizontal is the high water mark of that average true range. So as the price starts coming down, you'll notice the chandelier exits will start coming down as well. But my lines stay at the high water marks because that gives me an indication that I should consider selling when it crosses the first chandelier exit. Or trimming. I should trim some more when it hits the next one. And if it hits the next one, I should consider trimming more or exiting the position if it looks like it could be on a long-term downtrend. So UPS is a really good example. I was buying back here when I thought it had gotten way too underpriced. And the chandelier exits kept moving higher. That kept me in the stock. Anytime it was getting up here, if you don't have a process, you don't know whether this is the end of the run or whether you should continue holding on to it. But I could watch the chandelier exits and say, well, this thing's still moving higher, so I'll just continue to ride it higher. So one question I had was, Daryl, you have your trim point set below where it's currently trading. The answer to that question is I don't try to catch the absolute top. I would drive myself crazy doing that. If I sold at the very top and it continues to run up another 20%, then I lose out on that particular gain. So I wait for it to roll over. It hit a peak. I could see it was starting to downtrend and it finally hit my sell point. So I sold 15 shares of UPS at 115. A couple days later, I sold 20 at 112. So that was about 30% of my portfolio holding. But yesterday after I sold that, it was down 5% and it's going to be down, looks like about another 1% today so anyway, if I take this peak here and just drop it down there, that puts us in correction territory. So by using this process, I've been able to avoid this downturn. What's causing this downturn? Oil is definitely one of them. It costs UPS a lot of money to drive those trucks all around. Then if oil starts going up, if the economy slows down in any way, they deliver less packages. So that's what investors are thinking right now, and that's going to drive the price down pretty hard. So I hope this clarifies a little bit about how I use those and why, for my process, they actually work really well. One other thing is the RSI went from 60 down to 50 down to 40 in less than 4 days. That was a pretty big warning sign to me. Next one we'll take a look at. This is my largest holding. Once again, I didn't sell until it started hitting my chandelier exit, so I was able to, take advantage of this entire run here, which was 20% over 2 months. But now it is starting to roll over and it hit my trim point. So I did trim my largest holding by 20% over the last couple of days. What's causing this? Look at the 10-year Treasury rate. So during this run, the 10-year Treasury rate was coming down. That is really beneficial to REITs. We hit a bottom. We were actually oversold on bonds or overbought on bonds. And bonds, just like any other equity, become overbought and oversold. So the 10-year was ready for a bounce. And that's exactly what we're starting to see. And I think it's going to get back up to its average around 4.2. That is not helpful for REITs. I think this is going lower. But because it hit my trim point, I actually trimmed yesterday. So hopefully that helps clarify the chandelier exits, how I use them and how they, how they help me form decisions about when I decide to trim.
Very interesting. And especially the UPS chart, it was very pronounced, and this one here is beginning to turn. Just staying on this topic here for a second, it's a related topic, interest rates. It seems to me that with the new headwind of high oil price, the Federal Reserve might be more inclined to begin to lower rates. That's my thinking. What are you thinking on rates? What do you think is going to happen?
I think they may cut them twice this year, but I don't think they're going to go overboard on them.
Okay. They'd have to see economic slowdown, right? They'd have to start seeing some data that says we're slowing down fast and we got to start lowering rates because we don't want to have an unemployment problem, a big problem.
Yeah.
Okay. All right. Food for thought. All right. So let's continue on. I think we're to the point where we're going to take a look at some stocks. We're going to start with PBR, and that is Petróleo Brasileiro, and that's Petrobras PBR. And this stock over the 1 year up 29%. But look at this move. In beginning of the year, $11.50. Now we're up to $16. So just in a couple months, I mean, you could be up 41%. If you saw that maybe, hey, oil prices are going to rise, this would have been a very good idea. And you're being paid a very high dividend of 6.4%. So this is a really, really nice stock to be an investor in 2026. If oil prices keep rising, these oil stocks just keep following. It's a pretty, for me, it's a simple thesis when it comes to oil stocks. Look at the barrel price. What's going on with oil? Is it going to be a sustained high price? And all those things are not easy to determine, but you got to keep an eye on them. And that's what's going on with PBR. The forward P is really low at 7, and still looks good. Looking at their forecast, I'm sure this forecast needs to be changed because 2026 is supposed to have a contraction. I don't think so. I think it's going to have an increase in revenues just because every barrel of oil that they get to sell now is going to get a higher price. Pretty simple math. You get a higher price, everything else on your cost structure stays the same. You're good to go. You're going to make more money. You're going to make more profit. The other thing about Petrobras that I would point out is South America is a very big population. And if these guys produce oil, it could be consumed locally. It's not like they have to ship it around the world like Saudi Arabia or some other country. And looks like we have some investors in Petrobras. A member of this channel nominated Petrobras. That's why I'm starting here. And so overall, I think Petrobras is in a good spot, but so are a lot of other oil stocks. The earnings announcements, take a look at that. Here is their earnings announcement. And overall, what I'm going to do is I'm going to kick it over to Daryl, and I'm going to take a look at the earnings announcement and then do a valuation, update my valuation on PBR. I already have a valuation, but I need to update it. Over to you, Daryl.
Yeah, Shadow Guy says, give me a break about gas. California is cheap compared to here. He's in Switzerland. So I lived in Germany for 3 years between 1981 and 1984. And even then, they were paying about 3 times the price of gas that we were paying in the States. So they've been doing that for a long time.
Yeah.
Let's look at the PBR here. What were you going to say?
I was going to say, I bought an EV. So right now we own 3 cars. 2 are SUVs, and one's a 8-cylinder, one's a turbo 4-cylinder. It's amazing the turbo 4-cylinder has better acceleration than, and it's a hybrid, so that's why it accelerates well. But I bought an EV because the deals on EVs were so incredible in September. Was it September or October? I think it was September. And at this point, I'm like, well, I'm glad I have that EV because if gasoline prices go through the roof, we're going to be driving that EV. We're going to drive the wheels off of it. So back to you, sir.
So PBR, we looked at this one on Wednesday, and we put this auto support resistance line on these two peaks of the prices looking back 5 years. So when we zoom in a little bit, that's why that line is there. It did break out above that line, came down and tested it 2 times, and has since risen higher. Let's see, from that line up, it's been about 15%. They are trading, well, the market hasn't opened yet. So yesterday, they closed below their 5-day moving average. They did yesterday as well. Their 20-day is still sitting around 1591. Their 50-day, which is increasing, is sitting around 14, and their 200-day, which is also increasing, is sitting around 12. They did get into an overbought condition. And one of the things I'm noticing, and I don't know how necessarily to explain this with oil prices going up, but we have higher highs. But you'll notice here that we have a lower RSI. We also have a lower PPO. And if you've listened to me before, those are called bearish negative divergences. And at some point, that's going to cause the price to come back in line. I don't know when. Sometimes these can go on for months. We looked at the Google chart, and they can literally go on for months, but eventually they tend to pull the prices back down. So I don't know how we square that with oil prices going up, but the chart is telling me what it's telling me. So anyway, overall, I think they really look good. Look at this accumulation they've had since they bottomed out in December. The accumulation is not quite back up to a 5-year high. We're looking at 1 year here, but I looked at this also on the 5-year chart. It's not quite back to the 5-year high, but it's definitely making progress. We can also see that money flow is really bullish at the moment. The chart looks good. I do see a couple warning signals to keep in mind.
So I'm curious, when you look at your charts and you know that oil prices are rising, do you kind of use that as kind of an additional factor to consider as you see the type of chart data you're viewing?
I take it into consideration, but the charts don't lie to me. So regardless of whether oil is going up, I am seeing a bearish negative divergence. So, I mean, it is what it is. I don't try to explain it, but it is what it is. So we'll have to see whether oil prices, continue and drives this price higher, or whether the charts are telling the truth and it's going to bring the prices back down, a little bit. I'm not saying a lot, but it could bring them back down just because the momentum is not as strong. Over the last 3 days, we've had 3 selling days. 2 of those, this one here was above average, probably by about 10 or 15%. And this sell-off here was 2x. So I don't know what's causing people to do selling in at 2 times the volume, but they are doing it right now for whatever reason.
All right. So let's finish off the analysis together. And let me get my screen ready. Okay, so I've updated the free cash flows for PBR, and I'm going to update the earnings per share together here. But the free cash flows, this is right off their financials that they just reported, and this is coming straight from here. And also their cash balance and their debt is coming out of there. And this obviously, all this data is kind of rear view mirror. This is what happened in 2025 and as well as 24 and 23. The higher oil prices have been affecting 2026 numbers. So I think their guidance is probably, I mean, it's pretty simple. Hey, with higher oil prices, we're going to make more money. So having said that, when I updated those numbers, the stock's discounted by 28%. If I look at the free cash flows that I expect this year, which is going to be the cash flows they had this past year, 2025, I'm going to increase them by 25%. And then after that, they're going to increase by 4%. And I don't want to get too bought into, oh, we're going to have high oil prices for the next 5 years. I don't know that that's going to be the case. And I don't want to go that far. Like, whoa, we're going to just have a booming oil market for the next 5 years. Yeah, I don't know about that. The oil prices tend to peak and then they tend to settle down. We might have a year or two of high oil prices. We'll see. So, but even there at a very high discount rate, because this is in Brazil, I'm in the US, it's outside my home country, so I'll use a higher discount rate. So you're getting a higher rate of appreciation return out of a PBR versus like a Chevron, because there's a higher risk for me. Now looking at the forecast and where we think this stock is going to land on earnings per share. So this, I'm not bought into this. This is not going to do it for me. I'd actually say they're probably going to go about $11 per share in 2026. That would be conservative, because if they put up an $8.96 number in 25 and they're going to get better pricing this year, I'm going to go to 11. And you see how I'm taking this information and thinking for myself. I'm not going to just take what, stock analysis did nothing wrong. They're publishing research that is dated, and I'm not going to use that research. I'm going to use my own thinking here. We'll go to $11 there per share. It's so discounted. P/E ratio at 9. And will they grow that? Let's just go with 0 there. Just say, hey, they're having a good year, but I don't know that that's going to be the case forever. So this is an attractive proposition, as expected. If you have your commodity price, that's what these guys do. Go up fast. You're going to make more money, because it's not like, it costs more money to extract the oil. No, it costs the same amount that it was costing last year. In fact, as time passes, oil companies get better, more efficient at extracting oil. So, pick the stock you want to go with. PBR looks fantastic. I know that an investor asked for this to be reviewed. Awesome. A different investor asked about this stock 2, 3, 4 weeks ago, maybe a month ago. And it looked good then. Looks even better now, just because of the increase in oil. So PBR is looking great. The whole sector is looking great. I could kind of take a quick peek at energy and show you that it's been going higher. And energy is one of those things that I don't like when energy is doing great, because that usually means that everything else is doing terrible. And I would say that most everything else is not doing well this year. It's up 25. The whole sector is up 25%. And some individual stocks are doing really, really well. So This whole space is a good place to be, but at the same time, other places like materials, industrials are down. Real estate's down a little bit. Utilities are down a little bit. Healthcare is down 2%. Technology's up year to date. Interesting. That's really recovered, huh? That's a little bit of a surprise. All right, let's see what the heat map is going to show us here. Ooh, man, is it Christmas again? Why is it so red? Software is hanging in there. ServiceNow is trying to hold its stock price. Microsoft's holding its stock price. As expected, energy stocks are up. Defense companies are up. Meta's getting shellacked. Whew. Tough day for Meta. And yeah, some other like big banks are getting beat up. Okay. So that's where we're at, just 7 minutes into trading. So one thing I've noticed in the market that I think is encouraging is that each day, this week specifically, the market has gone down and then it's rallied higher. Maybe still ending in the red, but it had buyers come into the market and buy. We'll see if it happens today. We shall see. All right. So Ben 10 wanted to look at VNOM. So Viper Energy. Cool name. Viper Energy owns, acquires, exploits oil and natural gas properties in North America. Up 14. I expected this to be better. Look at that. So Viper is small cap, 15.75 billion. Forward P is a little high. Pays a nice dividend of 5.45. One thing I would say about oil stocks is they tend to pay good at dividends. So dividend investors, I imagine, like Chevron, Exxon, the big, integrated energy companies. And they also like these little companies, especially if you buy the little companies when the buying is good. I can't say that the buying is great right now because stocks have been going up in oil. But like you go back 12 months and you're like looking at these stock prices and you're like, okay, I could buy this stock before it rallied, right? This dividend rate was even higher. So you could have bought into this thing, have a little bit of, upside potential, in this case, a lot, and you're being paid a pretty good dividend rate. So you win two ways. So energy stocks, when you buy them at the right time, when nobody likes them, nobody's thinking energy is a decent investment long-term, great time to buy. I have not been buying a whole lot of energy this year other than Oxy, because Oxy did look good, but it's been hard to buy Oxy because it's been going up. Chevron's been kind of a stock that's just there, good size position, and it's been doing well this year as well. So Viper Energy looks like its fundamentals don't look fantastic, but let's take a closer look. And again, I'm probably going to run into a forecast that I'm not going to agree with, but let's take a look. So these guys in the last full year, 1.33 billion in revenue. It had a really nice pickup. They're supposed to grow. Man, these growth numbers look fantastic. And they're probably going to way overachieve on this number because the commodity price is going up. So I'm actually liking these numbers. I don't like these PE ratios, but I don't know if these forecasts are right. They're probably, these analysts, I don't know how often they update their information, but let's take a look here. February 25th, 24. That's pretty recent. This is old, too old. So this one's kind of recent, but the last 2 weeks, the stock prices the oil prices have really gone up. So it's looking interesting. So this is a good idea. I don't think this one's overly expensive. You see that the market really liked this stock. It really came down. Now that we have higher oil prices, this might be a really good idea. What do you think, Daryl?
So the last 3 days, just like PBR had been selling days. This one looks like about 5x volume. 10x. It's actually 10x. Wow. That's amazing. And they took a 5-6% drop that day. The next 2 days are also on big volume. They have gone from overbought to an RSI of 54, which is still bullish. I think I put see, I have this chart set up wrong. Yeah, I want horizontal lines, so let me copy this and fix the chart. I put it up. I need horizontal lines. I like to highlight the 40 and the 60 on the RSI. I didn't want a moving average. I just wanted the 40 line and the 60 line highlighted. So we've dropped down to 53, so we're still bullish, but we did get a sell signal on the 2nd of March. For some reason, it's in distribution and money flow has gone neutral. So I don't know what's happening over the last few days other than people buying the rumor and selling the news. PBR looks very similar in that way, and that could be what it is, that people are just selling the news. So they're trading right at their 21-day moving average, which has leveled out a bit. 50-day and 200 is still increasing, and all of them are in the correct order. So I'd keep an eye on this one. I'd watch it for another day or two. It's still falling right now. I just saw it drop down below the 21-day. But if it can hold this 21-day, that might not be a bad entry point, especially if the RSI turns back around. PPO is definitely indicating a sell at the moment.
Thank you, sir. All right, so the stock market is doing its thing. Looks like Broadcom is picking up some investors, and they had very good earnings. I created a video for investors or members of my channel, and their earnings are really good. Take a look at that video if you guys are interested in Broadcom. Microsoft, this whole space has been really sold off. So how much lower can Microsoft go? Looks like investors don't think much lower because it's been picking up a good number of investors and moving the stock higher. And it looks like the bleeding is kind of slowed down for Meta. I don't know why they'd be selling off so much, but that's what's happening. Maybe advertising would go down if we're going to have lower employment, higher oil prices, less discretionary money that consumers would have. Advertisers would lower their advertising spend on Meta, and that could definitely be a rational move on Meta. So that's going on there. Big banks are getting hit. Why do you think these banks are getting hit?
There are some concerns about credit risk, and the yield curve is can't remember whether they said yesterday, I can't remember how it directly affected it, but the yield curve is adjusting its shape at the moment, and that impacts banks as well. I didn't actually go look at the yield curve, but I just heard it on a podcast yesterday, and it made sense to me.
Okay. All right. So let's talk about Vertiv. That was another stock that was requested. And this one here has been such a winner, right? 1 year, 178%, 5 year, 1,121. And Vertiv designs, manufactures, and services critical digital infrastructure technologies. And, they make it sound like, wow, these guys discovered, the cure to cancer. I'm familiar with these guys, and not to like, say something negative about these guys, but they do products that are not that difficult to replicate, right? So they do cabinets for the data center. They do liquid cooling, which is plumbing, and again, these guys make good products. Not saying they don't, but the difference between an NVIDIA and a Vertiv is NVIDIA's got a patent that if somebody wants to replicate their technology, they they get sued, and NVIDIA will win. These guys are creating cabinets. Margins are not very good. So, yes, they are right in the data center. My concerns, and FYI, I've been wrong on Vertiv. Okay. My investing approach is look for businesses that make a lot of money, that are growing cash flows, and invest in those. When we look at the margins here, you see these margins are what, to me, this is a limited potential company because your best years are right now, 36%. These are going to be your best years, probably in the history of your company. You're probably going to get closer to 30%, which is more normal conditions. And they are making money because, again, these are the best years ever. Well, the best years ever for NVIDIA, they're making like 60% profit margin, 60% free cash flow margin. And these guys, best year ever, 18.5. So as we see some new stories appear in the investing universe, war with Iran, higher oil prices, instability, higher unemployment potentially. Maybe the investing community is going to begin to say, okay, let's kind of pump the brakes on data center, because if the economy slows down, Amazon's going to slow down. I mean, everybody's going to slow down. And there's going to be more concern and scrutiny and overall fear in the market. So the investors are going to be like, well, maybe the data center build out is too much. It's overdone. And these businesses are going to struggle to really get good return on invested capital, really good return on those data centers. And then it affects Vertiv. But to this point, if you take the stock price as the data, I mean, really that's the most important metric, right? Is, did the stock work? Absolutely. The stock has worked. It's flourished. For me, I haven't been in Vertiv because I see those fundamentals. I'm like, I'd rather buy NVIDIA. I'd rather buy Astera Labs. I'd rather buy something that holds greater value in my book. And this one hasn't measured up. I'm going to show you the valuation on this guy, and you're going to see that it's upside down on me. But before I do that, let me kick it over to Daryl to see what he thinks of Vertiv.
So they are trading above their 21-day exponential moving average, which is increasing. The 50 days increasing. The 200 days increasing. We had originally gone back 3 years on this chart and put this auto support resistance line here, which they broke above on October the 1st of last year, and they've been trading above it. They did come and test it here on the 17th of December, but have done really well since. One of the things that I'm seeing is we've got a lot of hollow candles here, which means it opened lower and traded higher throughout the day. I have two hammers here where we had the price really drop throughout the day, but buyers stepped in and drove price back higher. I see that on this candle and this candle. So the moving averages look good. It's coming down to test the 21. The RSI is still really good at 59. We did get a sell signal on the PPO on the 2nd of March, but I still see really strong accumulation, which is at a 52-week high. And the money flow is very positive, and it is nearing a 52-week high as well. So it looks good at the moment. This is something you want to get into. That 21-day looks like a pretty good test. It has recently tested a 50-day. So if you want to wait for a 50-day test, that would be good as well. Just remember to keep your stop losses in place.
Based on the valuation, to me, Vertiv, I can't touch it. It's overpriced by 43%. I'm giving Vertiv a very ambitious forecast on cash. I'm taking their cash flow and growing it quite fast. And I just can't get there. Again, the stock's worked. In my book, I don't want to buy it. There's plenty of choices right now. We have a market where stocks are being sold off quite drastically. And I need to stay in my lane. I need to stay in my lane to double my portfolio every 5 years. And my lane is technology, communication services, financials, industrials. I believe Vertiv is an industrial, right? Yeah, it's an
Yes.
industrial, electrical equipment and parts. And again, they're having the best couple of years in their history, and they're probably never going to see these years again. And we have bigger stories in the world right now where you've got a conflict in Iran. It's affecting the whole Gulf countries. So for me, I'm out. It's a sell. But again, congratulations. If you own this stock, congratulations. I tip my hat. You did the right thing. You bought it. You made a lot of money. For me, it's a sell. All right, so that's Vertiv. Looks like Kurt has arrived, and he wants to take a look at CRMD. I think CRMD you created a video for this one, right? Recently?
Yep, yesterday.
And the stock has been under pressure for some time. We've looked at CRMD multiple times, and based on memory, my concern is their growth. Let's go to the growth. The market looks forward. The market's driving its car and saying, I need to look through the windshield. Looking at the rearview mirror, that just tells you 25, 24, 23. That's what the company did. And it did come into the market, had some really tremendous growth. But as we look at through the windshield, we're seeing some red out there. And I think this is what's causing the market to pull back and say, hold on a second. So you grew this fast and now you can't grow. What happened? That just makes no sense. The best revenue growth trajectory that I like seeing is steady growth. You could grow fast, but just show me good growth over time. Don't show me 1 year and then you're done, because what that to me tells me is you are dominant in a very small niche in your market. You sold to every customer there was to sell to, and they bought your service or product. Now there's no more customers to sell to. So you've basically hit your ceiling. And I don't like seeing that. And the market doesn't like seeing these numbers, or I should say investors. This is hard to invest in because there's other choices in healthcare. And what we'll do is we'll open up United Therapeutics. Take a look at this forecast. So this is a different healthcare company, but a healthcare company. This is what I want to see as an investor. growth. And this is what is icing on the cake, cherry on top with sprinkles, a little extra whipped cream. 2029, 19% growth. So you see that acceleration. That's why United Therapeutics has been working, is their discovery of their drugs and improvements in their drugs, I should say, has been very effective. Great. They also have a moonshot. They're going to test lab-grown organs, and they have people that are willing to be on the trials. If they figure that out, I don't know what that market looks like, but my head's going to explode virtually. Like, wow, that's incredible for mankind, and that's incredible for United Therapeutics. Back to CorMedix. So if I have the opportunity to buy United Therapeutics, and I could list out other stocks, why would I buy CorMedix? There's just too much risk out there. Am I going to swing trade this? No, I want to double my money every 5 years. That's the goal for me. And I don't know enough about their science to be good enough to get in and get out. So for me, it's a pass, it's a sell based on that criteria. Now, can I show you a discount on that? Yes, but it's just, I have other choices. I'd rather go with the other choice. Let me hear what Daryl has to say on this one, because he did some research recently.
Yeah, so this one has been somewhat of a struggle with the price. With their guidance here on the 8th of January, they basically reduced their guidance, and we all knew that was going to be happening because their Medicare TDAPA reimbursements on their main product, DefenCath, is going to expire at the end of June. And without Medicare subsidizing the use of this product, which according to studies does save lives because it reduces the amount of infectious diseases and bacteria and fungus and everything else with kidney dialysis and those that need to be fed through some kind of a port that they use to feed people. This DefenCath product basically sterilizes that tube and keeps it locked so bacteria can't enter into the heart and cause blood infection. So they are the only one that has a product like this. They have 10 years of patent protection. What they are fighting right now is getting these reimbursements and getting their sales force in position to drive the product sales higher. They just purchased Melinta. They had a large sales organization. CorMedix has been around for 15 years or so, but they just became profitable last year. They did not have a sales organization, so they purchased Melinta, which allows them to pick up about 10 products that particular company had. They are also picking up an established sales team that already knows how to sell these products because their competitor that they purchased sold some similar products, but not like the DefenCath product. This one is going to take 1.5 years or 2 years. So if you were buying it, thinking it was going to be an instant return, this is not one of those games. You're looking at 1.5 years or 2 years out at least. This is a small position for me, but it's an important position for me.
And I like the comments that Alex is coming, to the stream with. Please keep stuff like that coming. And you're putting out that fundamentals look fantastic for this business. I'm not going to argue with that. They look fantastic. But I look at a business qualitatively first. Qualitatively means, is it a business that I think is going to prosper, or is it a business that's going to struggle? Is it a very desirable business? Is it an undesirable business? Do they like definition of moat, right? There's a lot of like qualitative decisions that you need to make as you assess their moat. When I look at this stock, there's just too many pitfalls. Qualitatively, I also look at what's the market condition. If I'm being offered, if you go into the store and you're like, oh, I need a new pair of pants, and there's 20 different brands, and your favorite brand is $100 a pair. You see your second favorite brand is $5 a pair. Well, I can tell you which one I'm going to buy. I'm going to buy 2 pair of the $5 ones and walk out looking like I got a really good bargain. And when it comes to stocks, what am I buying, right? Do I believe in the company? I showed you United Therapeutics. I could show you others too. And it's that qualitative decision that, I made is which business do I believe is going to be thriving over the next 5 years? Now, I also invest in businesses that are maybe more short-term, plays. If a business is really discounted, example of that more recently has been Target. That's been a good investment. I also invested in UPS when it was in its lows. Now, those businesses with tremendous moats, no. Am I going to be in those for the next 5 years? I don't know. I wouldn't be surprised if I sold out of both positions or one or the other. But CRMD, when we look at their fundamental data, their fundamental performance, it's incredible what they did. But we're not buying what they did. We're buying what they're going to do. And that's where it gets pretty risky in my book. So really good piece. Thank you, sir. Man, I'm going to watch this live stream again because I like that segment, by the way. Mike, the dividend investor guy, sold out of CRMD. And he's looking to catch it when it falls even further. Capitalism is in play, ladies and gentlemen. All right, what's going on, stock market? Broadcom, man, standing up tall. But look at this, Daryl. I'm seeing that the market's trying to pick itself up. It's in the ring with Mike Tyson, a young Mike Tyson at his peak. It's getting knocked down. It's getting beat up. It's getting bruised and battered. But it's like Rocky Balboa picking itself up, saying, hey, you can keep hitting me, Mike Tyson. I'm going to keep standing up. What's going on? What's going on with my Google Finance? Man, Google's got to put a couple more servers in play here. So not enough data to really see if the market's going to rise. But let me tell you, if it rises today, it's going to be one more occasion where I'm seeing that buyers are coming in the market. And I view that as a very productive data point. I'm also seeing a rotation into some of these severely beaten down stocks in software as potentially a honey hole of profits for me in the future. We talked about energy. We don't need to talk about energy much more, other than I'm surprised that Chevron and Exxon are selling off. But the smaller players are doing a little better. Man, oil prices are a lot higher. Why aren't energy stocks going higher? Interesting. Costco's going higher. That's good. They announced yesterday, right?
Yep.
All right. Anything you want to comment on what you're seeing in the market today?
Not necessarily the market overall, but we did have a question on Intuit. We can take a look at that. Who's asking about the chart setup?
Yeah, let's do it. I missed that question. Glad you caught it.
So we talked about this on Wednesday, and I said it's setting up very nicely. It is trading above an upward sloping 21, a 5-day. It's had all white candles moving up.
Does that mean a wedding is coming, or what do white
Yeah.
candles mean?
Means it opened higher or it closed higher than it opened. So we have 1, 2, 3, 4, 5, 6, 7 days of that.
That means that there's buyers coming to the market and buying up into it, huh?
Yep. Look at the accumulation. Money flow is still neutral, but we are getting lots of accumulation. We got a buy signal on the 26th of February. They crossed above the RSI 40 on the 27th, and they crossed above the 50 on the 4th or 5th. The one thing I caution about is overall, you're still in a downtrend. So the 200's declining, 50 days declining. So overall, you're in a downtrend. Just keep that as a big picture view. But I cannot argue with this right here. This looks really good. You're going to face a little bit of resistance right at gap, lower gap support, and the 50-day. So keep that in mind. But overall, I think Intuit is looking really good right now.
I agree. I'm setting up my comments here. Give me a second. All right, so I'm going to start by talking about Netflix, and then we're going to talk about Intuit. So at times the market says, this business in the case of Netflix is just absolutely undesirable. And to the point where we're going to sell it off by 74%. It's so amazing that big investors have came into the Netflix stock and it still kept going lower. And I would say that me personally, my lane, I invest on fundamentals, and I look at qualitatively, is the Netflix business different or the same as it was 2 prior years ago? Absolutely, it's the same business, except it's bigger, higher revenues, and it's expected to grow. So as I see this forming, I think the market's wrong. And not only did I think that, I put my money where my mouth is, and I invested big into Netflix. And I made a very good return on Netflix. All right, let's flip the channel. Or I should say, we don't flip channels anymore. We stream everything, right? So what's the right term there? Let me hit the back button on my remote. I think that's the right term. So our friends at Intuit, they do software products. Probably their brand that you probably know is TurboTax, and then QuickBooks, and they do Email Monkey and Credit Karma. I'm not familiar with Credit Karma or Email Monkey, not stuff I've ever touched. And if we look at this company overall, right, this is a big success story. And a long time ago, like a million years ago, back here, this founder, it's an interesting story, founded the company and he ran out of money. And he talked to his employees, and he assured them, I think this is going to work, and I can't pay you, but I'm going to give you more stock. And if you leave, I understand. If you stay, you have more stock. And those employees that stayed did really, really well. But you see that this stock's been a total performer, and then it came off a cliff here, and the market said Intuit, like Netflix, right? Remember the Netflix chart? Netflix is absolutely about worth as much as a solid bag of fertilizer over at Home Depot. And we're going to sell it off by 51.5%. Okay. Man, the business must be struggling. Let's take a look. The Intuit business must be struggling, must be going down in revenue, struggling big time. And the answer is no, opposite. So it did well in their prior fiscal year. We're now in the fiscal year that ends July 31st, growing at 15%. It's a pretty good sized business, 21 billion. So the fundamentals are saying business is growing. Its margins are very high. This is a software company with a very big network of customers. Free cash flows are fantastic. Look at this cash flow. Let me show you the chart. That's what I like seeing in data. Cash flows have gone up year after year after year, with a few exceptions, just a couple of exceptions, but you see where the trajectory of that stock is. Look at their gross margins. I talked about Vertiv earlier, right? This is why I don't invest in Vertiv. I could go buy an 80% gross margin business that's heavily discounted, that makes 21.5% profit margin, and the market's selling it off. Beautiful. You know, I'm walking into the department store. They're selling my favorite jeans at a 80% discount. I'm going to buy a pair of my favorite jeans. Free cash flow margin, 34%. Okay. In other sectors right now, other businesses would love to have these fundamentals, and the market's selling the stock off. So that's where the opportunity begins for me. It's a discounted stock. Don't need to pretty up the numbers. Actually, these are conservative numbers, 48% discount. So if I'm right, because I was right on Netflix, I was right on Meta, I was right on Google, buying them at the right time, I'm going to do well with Intuit. I think this stock's going to go higher once the market realizes, oh, this is Intuit. Oh, the AI, technology is not going to hurt Intuit. They keep growing. In fact, they're using AI in a productive way for their customers to use Intuit products more effectively. They love this, that, or the other. So that's the whole story on Intuit. And these stocks are so fun to invest in because, FYI, these are, how can I pick the bottom, right? I can't. So I bought into the stock. I think I'm underwater still, but I think at some point I'm going to start buying more shares, and I'm going to see this stock go higher. This is my expectation. Now, things could interrupt this, right? Like this war with Iran. Yeah, that could be an interrupter. But at the end of the day, we have a war with Iran. So are people going to not do their income taxes? No, they're going to do their income taxes. So they're going to use TurboTax. Are those small businesses going to stop doing their books on QuickBooks? No, those small businesses, that's like the lifeblood of our economy. So it's a pretty hardy business within technology. This is kind of a consumer staple like technology company that has massive margins. I've been wanting to buy into Intuit for like the last 15 years. I just never found the right scenario, and there were better alternatives. And all of a sudden the market dropped this in my lap. So I'm thinking that we're going to see this stock price reach $1,000 per share in the next 3 years. So that's a pretty big call, right? But that's my research. That's my research is telling me. And, I've been fortunate to invest in some other stocks where I saw this thing play out. And this is not like rocket science. This is like Intuit. I've known this company for last 35 years. I've been a customer of TurboTax for the last 35 years. And I've known a QuickBooks, dominant player in small software for small businesses. The changeover cost is really expensive for those businesses. These are, sole proprietorship companies, small businesses, maybe 2, 3, 5, 10 people. And they're working 60 hours a week. The proposition of, hey, we want to change from QuickBooks to product B. No. Is QuickBooks getting the job done? Yeah. If it ain't broke, don't fix it. Why would we take the risk of moving over our billing to our customers through QuickBooks? Our receivables are in QuickBooks. Our banks are connected to QuickBooks. Our payroll is done through QuickBooks, through services. All those things are in place. The roots are pretty deep. So switchover is very hard. Okay. And so I'm good with Intuit. I'm glad that the charts are beginning to show some encouragement, but again, this is stock investing, right? We could see another sell off. We got this war going on, and we'll see where this goes, but I'm in it. I'm in it long term. Looks like Tomas is in. He's on the software. He's on the software team. All right. So that was Intuit. And I missed the Intuit comment. I can't see it, by the way. Maybe it was a comment directly to you. So Mike is looking at, do you guys consider AXP and Visa to be safe areas? So I like Visa. American Express has never been like my cup of tea. So I'll put my bias on the table so you guys know how I'm going to go about American Express. But Visa has been discounted lately. And American Express, that's Warren Buffett's company. Mr. Buffett's made a lot of money on American Express. He bought it at a really good price, at a bargain, as he would say. And this stock has worked really the last 5 years. Look at that. Double your money. We were having a pretty good little sell-off, but you doubled your money. Visa has not performed as well. You did okay with Visa, but you see that the last year, what's going on here? Now, when you look at Visa and you see this stock performance, again, I like if I were to see Visa slowing its sales revenue, its profitability is waning, hey, this is rational, but let's take a look. And Visa's solid, man. Look at this solid growth. This is like, man, this is an oak tree. It grows 2 feet a year, just keeps getting bigger and broader, making more shade in your yard. And it's profitability. So what's the market thinking? Why is it selling off Visa? Now, if the economy slows down, less transactions on Visa, got it. But their moat is pretty damn, I mean, if you want an easy moat to understand, Visa, they own the network. Thousands of companies subscribe to that network, meaning JP Morgan issues a credit card and they use the Visa network. They have to pay Visa a toll, which is why when you look at the margins on Visa, they look like they came out of a comic book. Gross margins, 81%. Profit margin, 50%. 50%. Holy smokes, that's high. So I really like Visa where they're at. I haven't invested in Visa, but you can see why I like it, right? What do you think about Visa and American Express?
We'll take a look at American Express first. So I'm looking back 5 years and I put 2 auto support resistance lines, one down here around 175. That's where it was working in 22 and 23. And we had a really good run, and now we have another level sitting here about 305. So we'll go in for a year. And the 50 days declining, the 21 crossed below the 200. 200 still increasing. We had lots of sells with above average volume. RSI is 30. It's been on a sell signal since the 10th of February. And I would argue maybe as far back as December. I do still see accumulation to be pretty high and has been increasing this past week. But I'm going to go to fast graphs because you're going to see a very similar pattern where when it runs up really high, you have to keep an eye on when you're going to do some trimming because this gets overextended. Here's their fair value, the gold line. The market typically applies a multiple of 16, and it's trading up here at 24. So whenever you're watching these prices and it keeps getting that far extended, you need to be watching when it starts rolling over, because it did roll over and come back down to the market multiple. I suspect it's going to do the same thing again here. So on both the fast graphs and this chart, it just gets extended above its price too far. So you kind of have to expect that at some point it's going to come back down to quiescent level. So that's you want to look at Visa as well?
Let's I think Mike just wanted to focus on American Express. So let me update my evaluation. I'm actually going to create it on American Express, and we can kind of create it together here. So all right, so American Express, I'm going to look at the fundamentals, which are going to be free cash flow, earnings per share, and I'm going to look at another screen and update the data on this screen. Okay, so let's start with their free cash flow. I'm going to leave the discount rate at 7.5. This is a good business. I'm going to look at their balance sheet in a little bit. It may change, but I think it's going to be at 7.5. So when I look at trailing 12 months free cash flow, it's $1,894,000,000. Okay. And their growth rate, let's take a look at their forecast. And I looked at the wrong one. Well, hold on a second. I just cited the wrong free cash flow number. So free cash flow is 16 billion. 16 billion. Okay. And now let me take a look at their forecast. When I look at growth rates, I'm looking to see, the steady growing company, and they are growing in 2026 by 19.2%, which is a big bump. I mean, why would they be growing so much this year? Quarterly. Travel has been really good. Travel stocks have been doing really well. So I'm going to take that, and I'm going to say that they're going to grow cash flows by about 10%, which is what I had on MasterCard. Okay, good. Long-term growth at 4%. So this has that growth rate in that number. Now I'm going to look at the debt level and the free cash flow level. And we've got $47 billion of cash. They've got 63 billion of debt. Okay. Shares outstanding. Let me double check that number. 686. That looks correct. So it's discounted by 62% on cash flow. So the cash flow has been very tremendous. That's why Warren Buffett loves this stock, I guess. And the growth over the last couple of years has been really, really steady and really positive. Now let's take a look at earnings per share. The growth was really good this year. They're supposed to be nicely profitable at $17.75 per share. We're going to go with a 25 PE ratio. And going forward, we're going to grow that by 12%. So it's a discounted stock. It's a good looking stock. The growth rates are good. It's free cash flow. This is discounted better than MasterCard and Visa. So American Express looks really good. It's a stock that for some reason I've had a bias against it, and it looks like my bias was wrong. My spidey senses were off. So Mike, American Express looks good. I think it looks better than Visa and MasterCard. And the stock, I think the stock, let's see here. For the 1 year, I mean, it's performed really well, especially if you bought in 23. You doubled your money in less than 3 years, 2.5 years. It's a good one. Very good one. I'm going to add this to the watch list. I'm going to make a note to keep an eye on this one because I was keeping an eye on Visa, but this kind of interrupts that whole. Remember, we buy stocks in a market of stocks. You know, which one's going to give me the best return on investment, the best return overall. And I think American Express is looking better than Visa and MasterCard. All right, so I'm going to add that here. And while I do this, what's going on with your channel this week?
So I did put out the video on CorMedix. I was trying to get that out actually the day before. I ended up getting it out 1 minute before they posted their results. So my wife said I was cutting that one pretty close. And then I put out my weekly stock chart analysis highlighting certain charts within my portfolio that's helping me make decisions on the holdings within my portfolio. So I've been posting those weekly. And other than that, let me just show earnings because all the earnings are completed now. The one thing we don't have that you guys know that I track is the initial response and the price 1 week later and 2 weeks later. So I won't have those filled in for 2 weeks because Costco just reported last night, but all the earnings are in now. We had this is just for my portfolio. We had a 1.41% beat on the revenue, an 11.43% beat on earnings. That's pretty much in line with the market. The interesting thing is this initial response, only 30% was positive, despite a beat rate of 70. This was 80 last week, so we've had quite a few that have missed here recently. But the responses actually improved 1 week later by 16%. And then 2 weeks later, 43%, keeping in mind that I don't have all the data here and won't have it for a couple more weeks. But so anyway, this is one of those quarters where you had a good beat rate, beat by pretty good percentage, but yet the market was basically yawning. So that's it for me.
All right, good stuff. Thanks, Daryl. It's been awesome to stream with you for 3 days this week. And this market, I mean, it is a wicked market. It's like going skiing and you go on those double black diamond slopes. It's tricky, easy to fall. So what's going, wait, this does, yeah, it does make sense. Okay. So you see how today we kind of had this drop. Now we're beginning to rise. All right, keep going, stock market. You don't have to go positive, but you just keep going this way. To me, that's productive. All right, so good stuff today, guys. Thanks for bringing your stocks to us. Looks like the market is showing a little bit of appreciation on some of these software stocks. Broadcom's picking up some buyers. Let's get into it, Daryl.
Yep.
Think the market listened to your analysis.
Yeah.
Probably looks like we've got 33 streaming participants I imagine a couple of them may have picked up a share or two. Looks like aerospace and defense is, receiving new investors because they are probably using a lot of their products on that war. Looks like Exxon is picking up some new buyers. Costco picking up a bid. Nice. Go Costco. And a stock that I'm going to create a video on, I'll just kind of give you guys a preview. I'm going to create it and release it to members, is this bad boy. And I love boring companies that make me money. Just love them. I love how they just secretly make me money. And that's going to be Kroger. I'm going to analyze this, show you what I'm seeing in Kroger. They announced yesterday, and we're moving higher, folks. If you want to see videos that I produce real time, become a member. I produce videos, and about 30 days later, they go public. And Kroger is going to be another one. I released Costco this morning to members, and in 30 days, you can see my Costco video. And that's going to be how I operate. I appreciate you paid members out there. And I also appreciate everything you bring to these streams by bringing your stocks, your questions, and we get to learn together. Overall, this community has been really moving in the right direction, which is, I think I'm a better investor. Over time, I keep getting better, and I hope you're learning a lot from these streams. I've learned a lot from streaming with Daryl, because charts was never something that I took into consideration a whole lot, like the whole technical analysis. But now I have a little more knowledge, a little more appreciation. I'm still investing the way I was investing before, because I play to my strengths. Where am I good? What industries do I understand? How could I get into stocks that are going to help me continue to grow my wealth? So I'm going to keep doing that, but it's never a bad idea to listen to another person that has been successful in their investing approach. And that's certainly Daryl. So let's keep doing that. 2026 is going to be a tough year, but I think we get through it most productively if we just keep learning. You were going to say something, Daryl?
Yeah, I was going to say, I really appreciate streaming with you. I think any time that we can broaden our horizons a little bit, I think that helps improve, our overall approach. It's one of the reasons that I pay so much attention to macro. I know a lot of people yawn about that, but that actually controls about 50% of the market price action. So if you just totally ignore it, then there's 15% that you're not watching and is affecting the prices of your stocks.
Yep.
So to me, it's worth spending a few minutes a day just looking at the macro, getting more familiar with it. What do these reports mean? How do they change over time? Because it just helps me, fill in that 15% that I was missing. There was another statistic that actually affects the prices by 30%. What was that? I can't remember exactly, but it's also something that you and I spend a lot of time on. So if you're not, if you're just, if you're not paying attention to that stuff, then there's 30% of what's going on that you're just totally unaware of. So anyway, I like to understand that, and it's broadened my horizons by working with other people and look at the way that they look at the markets and how they approach things. So I think just broadening that just makes us all better and smarter investors.
I agree. And if anything, right, like understanding the technical charts and how a lot of investors really invest, if anything, helps me understand what the market's doing. And that's productive for me.
Yep.
And so all of that I agree with. One last glance on the market. I like what I'm seeing, Daryl. I'm seeing more green. When I first opened this thing up, it looked like it was Christmas all over again. It looked like I walked into a department store and toward the end of November, early December, when they got the whole place Christmas decorated.
Yeah.
Now we're seeing that, hey, Broadcom's moving, Microsoft got a little bit green here. Consumer staples are moving higher, energy's moving higher. So Google's not down as much as they were before. Meta went from being taken down to the mat to picking itself up just slightly. And we'll see.
Let me show two more quick charts. I was thinking about a question that somebody asked yesterday in one of the Discords about Microsoft versus Google and which one was closer to bottoming out. And I shared with him this chart and the Google chart. I want to share it with you guys as well. This takes 3 sets of averages. A short-term averages, basically 1 and 5 weeks, because this is a weekly view. This is 5 and 13 weeks, and 24 and 34 weeks. So think about this as long-term averages. They move really slow over time. Medium term, this is probably a year you're looking out. This is months, so you're talking a quarter or maybe a quarter and a half. This one moves a lot faster, or faster than this one. This one moves the fastest. So what we see is Microsoft most of the time is trading above these two averages, and those two averages, the lower one is higher than the shorter one. Okay. We have dropped into negative territory here. So a 1-year view out is showing that this is not very constructive, but it is already below the 0 line. We dropped below the 0 line on the 10th of November on the medium term. So that was telling us that things were not looking good over the next quarter to quarter and a half. And they did the same thing on the short term. You could probably go to about right here. It was just oscillating, but when it really trended and started its downward turn was on the 11th of or 18th of August. So this is negative in all 3 of those time frames. Now let's go look at Google. And they are still positive in the long term, but notice it's starting to roll over. And they've been positive on the medium term since the 27th of May. By the way, I'm owner of both of these. I'm not biased either way against either one of these companies. I'm just telling you what I'm seeing. But they went positive on the medium term and then have started declining, and they look like they could, in fact, they haven't crossed over yet. They're still above the 0 line, but they're probably going to cross over. And they've been pretty much positive on the short term since the 14th of April last year, but they did drop below in the shorter term. So the question was, which one is probably closer to the bottom? And the answer based on this chart, looking at 3 different time frames, Microsoft is probably closer to its bottom than Google is at this point.
All right, good stuff. I've been buying into Microsoft, by the way. I started buying into it recently because I agree with your analysis that it's been sold off, and maybe it's sold off too much. So, all right, so we'll leave it there, guys. You guys have a nice weekend. We'll be back next week. Hopefully you can join us. Enjoy the day, enjoy the weekend, and we will talk with you next week.
Take care, everyone.